Right. So qualitative characteristics are the qualities of the information, and then first one is relevance. Relevance states that the financial information must be capable of making a difference to the decisions made by users of the reports. Relevant information must be related to an economic, economic decision that will help them to form predictions or confirm their previous evaluations. Full stop. Relevance informs which information should be included and excluded. Next paragraph. Relevance is supported by the accounting entity. Assumption, right? For example, balance sheet for a business would include the assets and liabilities only relating to that business. As this information is useful for decision making. And this balance sheet will exclude the personal assets of the owner that is not useful for decision making. That is, also relevance is supported by the, remember which assumptions are? Relevance, period, and accrual basis. That is, an income statement should include the revenues earned and expenses incurred, only in the current period, as this will make a difference to decisions about this period's performance, which is the profit. Okay. Then the next part is materiality, and materiality is not another characteristic, it is actually a part of the relevance. Okay, so let's write this one. The size or significance of financial information determined by considering whether omitting it or misstating it from the reports could influence decisions that users make. For example, items that are too small or insignificant to make a difference to decision making may be considered to be immaterial. Meaning they can be reported as part of the value of a larger item. Okay guys, you can read it, I will explain. Done reading, please. Okay. Now, qualitative characteristics. Yes. Right. So, what are the qualitative characteristics? They are basically the qualities of the information that we come across in accounting reports. Right? Again, accounting reports we haven't done asset. Right? For example, balance sheet, income statement. Income statement is where we calculate the profit, all those for a business. Right? We list down all the revenues and expenses. So that's where we calculate the profit. Okay. Then balance sheet is the statement that lists down all our assets. Assets means what? Our resources. Right? Like you know already what your assets are. Right? The vehicles, books, clothing, right? Laptop, phones, right? Property. And the liabilities means how we generated money to purchase them. Like maybe can be own money, own saved money, or loans. So then basically assets will be equal to the addition of the liabilities and the money you contribute to purchase it. Right. Then qualitative characteristics basically talk about the qualities, right, or the features that should be available in the information in our reports, right? And qualitative characteristics describe how the information should be like, right? It says that look, this is how this is the nature of the information that we should have. Okay, so it should have some qualities, right? So for example, let's say when you think about anything, maybe let's say we'll think about a mobile phone. So when you think about a mobile phone, we know that there are some features, qualities that it should have. So we should be able to communicate, call, text, right? Maybe we can use the internet, right, on that, or we can manage our day-to-day activities, right? Probably we can have an organizer, timetable, or the calendar, right? Things like that. We can do that. Some activities. That is what we expect, yes, from the mobile phone. Now, same thing. When we think about the information, we are saying, look, there are some features, qualities in that. Okay. If you want, you can think about a person. You can think about a teacher. Think about the parents. Then we know that some qualities, or maybe a school student, we know that like how it should look like. Same thing here. Okay. However, there are 6 of them. So how many assumptions did we have? 4, right? And this one we have 6, right? Then guys, right, first one is relevance. As I told you, this is the most important and the longest one. Don't worry, the others are not that long. Okay? So this is like almost 1 page long. If you read the textbook, this is even bigger, but I have summarized it. Okay? Firstly, the first paragraph is what is more important and what we use more common. Right? What is it? Relevance states that financial information should be capable of making a difference to the decisions made by the users, right, of the reports. What does that mean? So, the information that is available in the reports should be able to make a difference, right, to the decisions made by the users, right? So, let's say a potential investor investor is going to invest in a business, right? So then by looking at the information, he or she should be able to make some differences to the decisions that he is going to make, right? So that is what it means, right? The information that we have included should be capable of making a difference. That means, what does that mean? In other words, we shouldn't include information that is not going to make a difference, right? That means, in other words, what we are saying is more important ones. I mean, any information that we think, that the accountant think that it will make a difference to the decisions, then we have to include such information, right? And we can't miss them out, right? Okay. So in such a way that, what is it? Next paragraph. Relevant information must be related to an economic decision that will help to form predictions or confirm their previous evaluations. What does that mean? Let's say an investor had told that this business is good. Let's say business A is good, business B is bad. By looking at those reports, right? By looking at those reports of business A, that person should be able to form prediction. Let's say like he thought that it was good, then by looking at that, yes, then he can basically confirm the previous evaluation. Then let's say, for example, imagine like what he thought was wrong, this business A is, he thought it was good, but when we look at the reports, it's really bad. Then he can change it. So basically he can form prediction. Then he is thinking, this is going to be bad, this is going to be bankrupt, right? So then he can confirm the previous evaluation, otherwise he can form predictions about the business, right? So then, so basically the information should be relevant for the decision making, technically, right? Then on the other hand, guys, relevance informs which information should be included and excluded, right? It will figure out what information should be included in the reports and what shouldn't be included, right? Or that should be excluded. Right. Okay. Now we'll talk about how relevance is linked to the accounting assumption. Remember, when we were doing accounting assumptions, we said that it is supporting relevance. Now we are saying relevance is supported by the assumptions. First one is accounting entity. Now accounting entity, if you can remember, we said that the assets and liabilities or the business transactions should be separated from those of its own. Same thing. Why do we do that? Except accounting entity assumption, why do we do that? To make sure that we have included only the information that is useful for the business. If we have mixed it up, then it's not going to be useful for the business, right? So then investors would think, this business has a lot of assets, but it is wrong. Why? Because we have included, or they have included, owner's personal assets as well. Make sense? Right? Otherwise, we have included owner's personal liabilities. Some people would think, this business has a lot of loans. Why? Because we have the owner has included the owner's personal liabilities, personal loans also in the business information. That's wrong. Right? Okay. So what do we expect from excluding the business owner's personal assets and liabilities from the business ones? To basically make sure that the information is only relevant to the business, so that the people who are making decisions about the business are basically safe. They are making decisions on the correct information, right? They are not misled. Yes. Okay. Then next one. Also, relevance is supported by the period and accrual basis. They are quite similar, right? In this case, the impact on the relevance from the period and accrual basis is quite similar. Why is that? Because we said that, guys, there is a common thing in accrual and period assumption. What's the common one? We said that, what is it? Revenues earned and expenses incurred for a given period should be reported in that particular period. Why? So that the profit we calculate is correct. So then we haven't mixed up. So let's say if you are going to calculate the December's profit for our business, we haven't included the expenses from November, or we haven't included the revenues from January. It is just mainly on the revenues and expenses related to December. That's it. Makes sense? So that our December profit is accurate. Not only December, other periods reports or other periods profit is also accurate. Why? Because we have correctly and nicely separated the revenues and expenses into those respective periods. Does that make sense, guys? Yep. Right. Any questions up to now? Yep. Now, let's talk about the other part of the relevance. Materiality. Materiality means what? You know the meaning of material, yes? What is material? Substance, yes. The composition, yes. Yes. Material, yes. Any other thing? Material?
Like material goods.
Material goods.
Yeah. Materialistic.
Materialistic. What does that mean?
Like you prioritize goods over. I don't know how to explain.
You mean like material in the sense you are saying like that it has a physical existence?
You prefer like a tangible
thing
rather than something intangible.
Okay. Anything else material? Right. Actually, yes. Now this materiality is material is different from what you said, right? Materiality. Materiality means what, guys? What is materiality? Materiality here. Basically the significance, the size of the information, whether it is significant enough, right? Material enough, right? How large or how small it is, if it is material. Okay, I will explain. Basically, let's say when we think about a particular transaction or an item size or significance, we will determine its significance based on how important it is for decision making. If we think, or if we can determine that it is important in decision making, yes, we will include it in the business reports separately, right? Let's say we think that it is not that important, it is not significant enough. Then what do? We will report it as a part of another item. Okay, does that make sense? Or no? Yeah, probably you might have understood to a certain extent, but I will give you an example. Then it will make more sense. Right. Now this is the thing, guys. Now see the definition. Size or significance. Right. That means the size of the financial information will be determined based on if it was misstated or omitted. What do you mean by omitted? Omitting, everybody knows what omitting is. Yes, missing out. Right? Misstating means we have actually probably recorded it incorrectly. Right? Maybe like 50 has been recorded as 55, or 50 has been recorded as 500. Right? Mistake. Okay. So that omitting or misstating it from reports could influence decisions. So that our mistake is going to influence the decisions of the users. Right? Let's say if it is going to influence, if it is going to change the decisions of the users, right, of the business reports, then what do you think? It is material or immaterial? Material. Does that make sense? Or you're listening? Right? Let's say we have recorded a particular item incorrectly, or we have missed it completely. So that particular mistake that we have done, that means recording it incorrectly, or we have missed it out completely, our mistake is going to influence our users, meaning is it an important thing or not important? Important. That is what we call material. If it is not going to really, not going to change that particular thing, like let's say our mistake is not going to influence their decision, right? Then that means it's not material, immaterial.
What's
Right?
an example of material?
Example I'm going to give you right now. Okay, I know like sometimes you didn't understand 100%. Yeah, you don't have to understand 100% because why? At your level, I understood nothing. Okay, right. So I was a kinesthetic learner. You know the meaning of kinesthetic? We can learn on 3 methods, right? Either we are audio learners. That means by listening we can learn. Yes. Some people are visual learners. Visual means by looking at it we can learn. And some people, neither of them, like me, kinesthetic, meaning I had to go home and read it and figure it out. Okay? Right. So then, now this is the example, guys, for this materiality. Now let's say, okay, imagine a big business like Coles, right? Big business, okay? What it is? They purchase a calculator. And maybe calculator is how much is the calculator, like how much calculator? $20, $50 or something like that. So they purchase a calculator. Calculator is actually, what is it, guys? Do you think it is an asset or an expense? Asset, that because you can use it for longer time. Yes, can you use it 1 year or more? More. You can use it, right? Basically, we call them the assets that we can use for a long time. We call non-current assets. Don't worry, we are going to do that. Yeah. Current assets means like short term, maybe like your pencil, stationery pens, right? They are short term. But long term ones, like your phone, computer, right? Vehicles, property, furniture, they are long term, right? So we subdivide short term and long term assets in our reports. Okay. So technically, calculator should be, what is it? Actually, it is a long term asset. Technically, yes. But it is just $20. Now imagine like Coles other assets, maybe in millions. Right? Now we are going to include that $20 in the assets that is worth of millions. Now my question, is it going to change the no. So before I answer the question, you know the answer. Is it going to change the decisions of the users? Like we include $20 in that assets, that calculator worth of assets, calculator worth of $20 in the assets, right? We have included it in that or not included in that. Is it going to change the decisions of the users? No. Why? Because other assets are in millions. And no. Or maybe it can be even billions. I don't know exactly. Millions. Hundreds of millions. So it's not going to make a difference. So then what do we do? What do we do for that transaction? Still we have spent $20. What are we going to do? Are we going to forget it? No, then what do? We will record it as an expense. Okay? We will record it as an expense. We will say it's an stationery expense. Office expense, whichever it is. That's it.
What if your expenses are millions?
Yeah, that's fine. Still we have recorded because we can't forget it. We can't say, this is just $20. No, we can't forget it. Still we have recorded, right? So the point is it should have, like, technically speaking, we should have recorded it as what? Asset. But no point, right? Maybe expenses also. Office expenses may not be in millions, but still there are stationery expenses may not be in millions, but still we have recorded as an expense because there is no point in recording it as an asset. And in the future we have reduced its value. We call it depreciation. We are going to do that. Probably if you are doing, general maths or something, or maybe a 10 maths, you might have done depreciation. Have you done concept called depreciation? Yes. Yeah. So
Normal maths.
normal maths you have done 10, yes? Yeah. So depreciation means we reduce the value. So we systematically, we do it in accounting. It's one major topic. Right? There are many methods of depreciating assets. We are learning them. Unit 2. Unit 2 we do only one method, but Unit 4 we are doing 2 methods. Okay. Any questions, guys? Do you understand relevance and materiality? Good. Let's write this next one. Faithful representation. Financial information should be a faithful representation of the real world economic event that it claims to represent, where such information should be complete, free from material errors, and neutral. Next one. Complete. Refers to information that it presents the whole picture, including a description and a dollar value. Next one, free from material errors. Refers to information that is accurate and can be checked or verified to support its accuracy. Immaterial errors do not affect decision making. Next one, neutral. Without bias means information that is not subjective or based on estimates, where information can be verified by source documents. Yeah, let's discuss this one as well, because this one also has little bit of information, but don't worry guys, the rest is very short. Only the first two are quite more informative, but the rest is shorter ones. Yeah, go. Let's write the other one, guys. Verifiability. Financial information should allow different knowledgeable and independent users to agree that an event is faithfully represented. Verifiability is maintained by retaining source documents. Verifiability is thus a core way of ensuring that faithful representation is upheld. Right. Okay. Now listen, guys. Right. Faithful representation. Right. Right. I think you know the meaning of faithful. Yes? Faithful. What is faithful? Trustworthy. Yeah. So reliable. Sorry?
Like proper representation.
Proper representation. Right? Okay. Faithful. Faithfully represented. Right. Now this one is talking about, guys, the financial information that we come across in the financial reports, right, are basically reported in a trustworthy manner. Right? But we can't write that in the exam. Right? How we are going to write it in the exam is like meaning of reporting the information faithfully says that we have to report the real world economic events, right, of the business, right? We report basically the real world. So the faithful representation says that financial information should be reflecting the real world economic events in such a way that such information is complete, right, free from material errors and neutral. Now, in this one, guys, mainly I see in this definition, that's all, that's it, basically. Faithful representation means what? What I have written in blue, right, up to the blue, up to without bias, right, that's it. Then the rest is the explanation. So it has mainly four actually components in this definition. First one is real world economic event. What do you mean by real world economic event? What has happened in the reality? Like what? Let's say what has happened. For example, let's say we purchase a computer to the business, right, today. We purchase a computer business today, let's say $2,000, right? That is what we call is, that is what has happened, right? Basically what will happen, our computers in the business will increase, our cash at bank in the business will decrease. Why? We go to the shop and purchase a computer. So money decreases and our computers will increase. That's the reality, what has happened. Right. And then such information should be complete. Complete means, guys, complete, I have given you a explanation, meaning we have reported the whole picture. Whole picture in the sense, only two things. A small description about the transaction and dollar value. That's it. Then how are we going to record it in the business? I will say purchase a computer, $2,000. That's it. You can't just write computer without a figure, right? We have to write the figure, or you can't just write the figure itself. You have to write what it is, right? Because if you just write 2,000, you don't know what it is, what has happened, right? You just have to say computer 2,000. That's the meaning of complete. Next one, free from material errors. That means 2,000 we can't record as 200. Right? 2,000 being recorded as 200, is it material or immaterial? What do you think? Material, yes, because we have reduced it by 1,800, that's wrong. 2,000 has been recorded 200 incorrectly, meaning it's a material error. You can't record like that. Maybe 2,000 has been recorded as 2,002. That's okay. It's not that material. It's not. It's basically $2. It is maybe material. Right? $2 is not that important, yes? Right? Okay. Then we can't have material errors. It doesn't mean that purposefully we should record 2002, right? No, 2000. But sometimes there can be some mistake. Okay. They can't be material. So again, material. If you ask me what material is, then again I have to send you to the material thing. If it is going to make a difference or influence the decision makers, that's what we call as material. Yes. Right? So 2000 being recorded as 2002 is not going to really make much difference. But 2000 recorded as 200, an issue. Okay, it is material. Next one, guys. Another thing is in the free from material errors, refers to information that is accurate. 2000 should be recorded as 2000 and can be checked or verified to support its accuracy, right? Right. So then we can So if somebody wants to check, let's say the accountant has recorded as 2000, then owner wants to make sure that it is 2000. Then how can the owner is going to verify it from a source document? So there can be the invoice, right, or the receipt from the place where they purchase it, and then owner can verify. Right. Next one, neutral. Neutral means without bias. What does that mean? Without bias means, guys, we can't have subjective information. What do you mean by subjective? The opposite of subjective is objective. What's the difference, guys? Subjective means it basically changes. It includes opinions. Subjective. That means if I ask you a question about today's weather, you will say, it's good, right? Wonderful. Or another person will say it's cold. Another person will say hot. It depends with the person, right? So it is basically depends. But if somebody asks what the temperature it is, that is objective. It is not subjective. It is really, right? This is what the thermometer says, or whatever it is, right? We can measure it accurately, right? Okay. So then we can't have subjective information, subject to people, right? Meaning we can't have opinions. Right? We ask like how much the computer is, right? From the accountant says, I think it is 2,500. No, we can't say what he or she thinks. We have to say, it is 2,000. That is how we can verify from the source documents. Right? They can be verified. Okay. Next one, guys. Verifiability. Right? Verifiability is also related to the faithful representation. Why? At the end of the day, verifiability is also supporting faithful representation. See, financial information should allow different knowledgeable and independent users to agree that an event is faithfully represented. Right? What does that mean? So, financial information should allow different knowledgeable. Different knowledgeable means, let's say, you go and check the report, and I go and check the report. So different knowledgeable people, because I have more experience in accounting than you. So then whether you go and check and I go there and check, both of us can agree that this information has been reported correctly. Let's say computer has been recorded as 2000. That's correct. Either way, regardless of their knowledge or their dependency, right? Maybe independent in the sense, guys, like maybe owner goes there, owner is the owner of the business, yes, right? Or we go there, right, and we check, same thing. We will conclude that, look, this is fine, this has been reported, and then usually verifiability is maintained by retaining source document. There will not be any source documents, yes. Source documents, what are the source documents, guys? Supporting documents, right? So basically like invoice or receipt. When we purchase something, we get a receipt, yes, which is a source document. Usually what I call is source documents we did, yes, little bit in the accounting process. Source documents what I call is like birth certificate, was, right? Similar thing, yes. So it basically confirm, right? It confirms that the person is born. Same thing. Source document confirms that transaction occurred, right? Okay. Verifiability is thus a core way of ensuring that the financial representation is upheld. Yeah, this is not that important. What is important is the first paragraph. Okay, guys. Shall we do some questions? Right? From what we did? Okay, please read the question. I'll help you. Okay, guys. Now, in each of the following situations, identify appropriate characteristic and explain how it should be applied. As we did in assumptions, we are going to do the same thing here. Right, part A. Anne took 1,000 from the cash register of her business to pay for her son's school fees, saying that this is my business and I can use my business's cash as I wish. Yes. Yeah.
Well, breaches the accounting entity assumption,
Accounting entity assumption.
Yeah, which inclines me to believe that it relates to, like, the relevance.
Relevance.
And materiality.
Okay. Yeah.
Yeah, I'd say also relevance and material.
Relevance and material. Okay. What do you think, Sneha?
Relevance.
Relevance. Why is it relevance?
Because she's taken $1,000 get that from business reports?
Business records, yes, very good. So, yeah, actually, just for your information, we have something called when the owner withdraws business assets, we call drawings, right? We are going to learn that in details in the future. We call drawings. We should record it as a drawing. Okay, right? Then but you don't have to really worry about the materiality here, right? You can say relevance. Why? Because this is not a business transaction. This is a owner's personal transaction using the business cash, so that we have to report it as a drawing. Yes.
Could she mention materiality since it's $1,000?
No, you don't have to really worry about that materiality at this point. Yeah. Because why 1,000 is? Do you think it is material? Yes, it is material, right? We have to record it.
That's what I meant.
So then, what did you say?
That's what I meant.
Then,
It's 1,000, so it's material.
yeah, it's material. Yes, yeah, this is material. Okay. So this one is, guys, relevance. Right. Any transaction that is capable of affecting decision making must be recorded to recorded according to relevance. The withdrawal of business cash for a personal expense by the owner is relevant to the business and it should be recorded as drawings. To ensure that the owner's equity is not overstated. Owner's equity, guys, we haven't done asset, but we are going to do in the accounting elements, which is our next topic. Right. Any questions with this?
How many topics are there?
How many topics? For conceptual framework, there are 3, but in terms of topics, there are many.
How many are there, like, across one, two?
Topics, you mean like
Like the
chapters?
like tutorials.
Tutorials is different to the topics, Tinora. Tutorials in Unit 1 and 2, as I remember, there were 28 or 30. Don't worry. Don't worry about the number of the thing.
Is there more in 3-4 or is it the same number?
In 3-4, yes. I mean, the 3-4 tutorials, there would be more. I mean, in terms of the tutorials, there would be around 30, right, or 31. Last year I had 30. This year I might reduce it because I'm going to do more papers. We are going to cover about 30 to 40 papers before you guys go to exam.
So that all those tutorials cover all the theory?
All the theory, don't worry about it. Yeah. And also, I think I told you, some schools, especially, I won't talk about the government schools, like if you compare private schools, sometimes I know Haileybury, my students say that these things they have asked, the school teacher has asked them to do, to do it by themselves in the holidays. Okay, so see, even those schools, high-end private schools also don't cover sometimes this theory. But don't worry, I'll cover it. I don't ask you to do self-study. Alright? I'll teach you because this is very important. That's where the students basically struggle because schools and also sometimes tutors don't do the theory well. So when you do the theory, when I introduce you the theory, which is the background, which is basically the foundation. If the foundation is solid, so basically we don't have to worry about the strength of the building. Same thing. If your foundation in the subject is strong, solid, we can basically go, very high. Yes, we can achieve a very high result, right? Yeah. So applications, maybe you could be boring. You could be bored at this point, but don't worry. After the accounting elements, which is the next two, then we are starting the numbers, right? Maths, numbers. Okay, we are going to do the reports. We start from balance sheet. Right? Yeah. Okay, guys. Next one, part B. Is this question familiar? Same as the previous one. But what is the thing? This one is a characteristic. Earlier I asked you the assumption, yes? This one is a characteristic, guys. See? Now the same thing, like in the future you will be given this question, then I would ask you to talk about both assumption and characteristic. Then you basically combine your answers. That's it. Exactly same thing that they would ask in VC. From one question they can tell you, talk about the assumption and also characteristic. Yeah. So now see, when you have the experience, when you know the knowledge, when you have the knowledge, you can answer any question. So let's say you know how to drive a vehicle well, then you don't really care about the road. Yes, you can drive on any road. Yeah. As long as you are competent, you can do anything. Right. I'll give you the answer. What is the answer? What is the characteristic, guys, here? What do you think? Yes. Not sure.
Is it relevance?
Relevance.
Verifiability.
Verifiability. Which one out of those two, or both? Both. Tell me one of them. Verifiability.
Not sure.
Not sure. Verifiability is correct. Why is it?
Oh, it's because first, it doesn't reach period, accurate basis, or accountancy,
Mhm.
so it eliminates relevance. And then it appeals to verifiability because it states that it allows like different users to like agree that an event is faithfully represented.
Mm.
And this, it's basically avoiding that because it's three independent valuers agree on the hairdressing score.
Mhm.
I believe it's verifiability.
Hmm. What do you think, Sneha? Why did you say verifiability, Sneha?
Like same thing. Like three different people have given like three different
Values.
but they should agree.
Yeah.
Like based on like objective, like instead of like their own personal opinion.
Okay, so then what is the objective information here?
The value that they have,
The value? Yeah. Well, how much? What is the value?
400,000.
500,000.
Why is it 500,000?
Because that's what she purchased it for.
Purchase it for. So as a result, it can be. It can be what?
It's the source document.
Yes, verified. That's the point, guys. Yeah, basically, yeah, she basically came to the point, right? So it is the one that is verified. There's like different people will say, ah, look, this is 1 million, 1.5 million. We don't really care. Why? Because we don't have a source. We don't have a basically a base. Yes, we are saying, look, this is my property, 1 million, 1.5 million. Then that's just an opinion. We don't really care. Why? Because it's subjective. Okay. Right. Okay, guys. Please write verifiability. Right. So write there. Premises should be valued at its original purchase price, as it can be verified by source documents. Remember, we talk about the source document, yes, under the verifiability. Yeah. By recording it at this value will allow different knowledgeable and independent observers to be assured that it is faithfully represented. Okay, guys, for homework, Please try. In the question number 1, part D. NH. No, don't worry. H is a bit hard for you. See, in the homework thing, part C. Yeah, just those two. The rest are a bit harder, right, for you, and then yeah. Okay, guys, and thank you.